everyone, and welcome to William Buck Investment Series 4 on small companies. Today I have George Capozzi from Hayborough Investment Partners with us. Welcome, George.
Great to be here, Adrian.
In our previous investment series, we have talked about large caps, renewables, these sort of things. Today we're talking about small companies. What do you mean by small companies?
Well, traditionally, Adrian, small caps are defined as businesses outside the top 100 on the ASX. I think a small cap investor would typically think of a small cap between $100 million market cap and $1 billion. And it's a pretty fertile hunting ground for investors. You know, it's a fantastic place. It's a more diversified area than the top 100 stocks. If you're thinking about the top 100's made up of 50% of its banks and resources. Whereas you've got another 2,100 stocks outside of that is a fantastic place to invest. Lots of diverse businesses run by passionate, intelligent management teams, and we think it's a really fertile ground.
Yeah, probably one of the better ways. So 2,100, still a lot of companies. Can you give an example of something you've bought maybe in the fund that might bring that to life?
Yeah, we might break that down. So out of that 2,100, half of those businesses they don't generate any earnings. So got another 1,000 businesses there. Half of those wouldn't meet our investment criteria. So there's probably 500 businesses that you can really focus into and do your research. Within those, we think that there's a good chance you're going to make outsized returns by building a portfolio of high quality companies. An example might be of a stock we hold is Mainstream Group Holdings. Very boring business. They do funds administration for some of Australia's largest fund managers like Magellan, Macquarie, Pendal, Perpetual, etc. Very boring business, but the management team are laser focused on delivering outcomes for their clients. It's a really important part of funds management, NAV pricing, administration, fund accounting, talking to the investors, and but they're laser focused on making sure that their clients get a fantastic experience. The management teams, they live and breathe the business. They've been running the business for 15 years. They own 50% of the stock. I'm comfortable investing next to them because I know they're not going to blow the business up. They've got their own money alongside ours, and we can trust them. And we've known these guys for a number of years, so and everything they've said, they've executed on. It gives us the confidence when we do have a market dislocation to buy a business like that.
Yeah. So when you bought a business, you do so much due diligence. I imagine you're doing that with other companies as well. What about the sell side? Because it's easy to fall in love with a company, I guess.
It is. So selling is probably one of the hardest part of an investor's journey, because you can do all the work, all the due diligence, but when do you sell? And we sell for a number of reasons. One, the thesis has changed, or the thesis has run its course when we buy a stock. Perhaps their runway for growth has come to an end, so we'd exit the company. It might be that we were wrong in the first place. That happens. We're big enough to look ourselves in the mirror and say we were wrong. We learn from that and we move on and we sell quickly. It could be that we've lost the trust of management teams. That they might be using aggressive accounting policies. They might be paying themselves too much in their compensation. They might have lied to us, or just not delivering on what they've said over the years, and we'll tend to sell for reasons like that. And the last one, I guess, is valuation. Very hard to sell on valuation. We tend to make that the least reason to sell, because good quality companies tend to stay expensive, and you find, if you look back over the history of time, good quality companies are expensive 10, 20 years ago, are still expensive now, but they're multiple of their share prices because they can keep reinvesting that capital quite profitably. They can allocate capital so shareholders can actually generate a really good return despite perhaps slowing their growth over a number of years.
Okay, so the sell disciplines clearly works. You've got some great outperformance. I noticed there's a number of small cap managers that do outperform the small cap index. Why do you think that is actually the case?
Well, there's a lot of high quality businesses outside the top 100 stocks, Adrian, that they're smaller in size but not lower in quality. And if you're prepared to do the research, do the work, you can find yourself with a high quality portfolio of businesses. The stockbroking industry is designed in a way that they don't cover a lot of companies outside the top 100 because it's just they just don't get a return on their investment when they put an analyst on a stock. It seems funny that some of the highest quality businesses on the stock exchange don't have any analyst coverage or are recommended to clients, because stockbrokers make their money by two ways: raising capital or trading. And a lot of these good quality companies are self-funding and can fund their growth over a number of years, never have to come to market to raise capital. Or they can be quite illiquid, so they can't get the large fund managers into the stocks. So great place for small cap investors like us to generate outperformance, and even better, smaller investors with smaller amounts of money to invest. It's a fertile hunting ground. And that along with the management teams of these companies own a lot of the stock themselves. They think like investors. They're passionate, intelligent people who are intelligent experts in their field. We want to have our money right next to them. So they're getting out of bed every day to making sure that, you know, their business is going in the right direction. They're not going to blow it up by making a silly acquisition. Their staff are engaged, and with all these factors lead to outperformance within that index when you find the right businesses.
That's outperformance of the index. The thing I really want to touch on now, especially for our people watching, is what's the market look like going forward? We've had a good recovery. Is it going to continue?
I mean, again, the good thing about small companies, there's so many to choose from. So we don't have to worry about what the market does. We can go and hunt the opportunities wherever we see they're most fertile. So, you know, as I said, there's 1,000 businesses. We can break that down to 500. There's so much inefficiency within that market that companies are trading for less than what we think they're worth over the years. So there's always opportunities. So Ben and I, we do a lot of work on these companies. We might not own them, but we do a lot of work on these companies, and we might follow these companies for 5 or 6 years. When the time is right and we see that the valuation of these businesses doesn't match what their stock price is trading at, that's when we'll go and buy them and add them to the portfolio. So there's always opportunities. We don't have to worry about what the index does, and there's always some new fantastic businesses coming to market, which we'll look at as well.
Fantastic. Well, thanks a lot for today. It's good to have someone actually in the studio, so to speak. Being a South Australian fund manager, I think you're one of only 2 or 3. So thanks a lot for coming in, George, and telling us more about small companies.
Thanks for having me, Adrian.
Pleasure.